Thank you. Good evening, everyone. I would like to call this meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Ojibwe, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Carrie Linklater, and I am your chairperson this evening, and I am joined on the panel by Mr. Kent Seelan and Mr. Richard Whitbread, who are on Zoom also. And from the assessment department is Ms. Jennifer Martins, and our administrative personnel is Ms. Phoebe Graywood. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. Board of Revision is appointed annually by City Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the Board will deliberate in private and make its decisions. You will receive the Board's decision by registered mail as soon as possible. And as information, all public hearings are live streamed, recorded, and will be part of the public record. This evening, we will be hearing items 6 through 9 on our docket. And Ms. Graywood, would you please affirm the assessor and the applicant's testimony?
Ms. Martins, please state your full name.
Jennifer Suzanne Martins.
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. And Ms. Cates, please state your full name.
Cates.
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you.
Thank you.
Thank you. Good evening, Ms. Cates and Ms. Martins. Our first property is item number 6, which is 1-4-100 Bismarck Street. We are looking at a value of $2,036,000. And Ms. Martins, whenever you're ready.
Okay. This is roll number 0900556200. It is 1-4-100 Bismarck Street for the roll year 2025 with a reference date of April 1st, 2023. The assessed value is $2,036,000. This is classified as 20, residential 2, and the liability status is T, taxable. This is an apartment building. There are 3 buildings with 2 stories. It was built in 2010. There are 12 suites. There are 4 indoor parking spots and 8 outdoor parking spots. If we look over on page 3, please. We have that there are 12 2-bedroom units with an average monthly rent per unit at $1,167.64. That gives us a gross potential rent of $168,140. We have a vacancy rate of 2.6% and expense rate at 44.06%. That gives us a net operating income of $91,612. We've applied a 4.5% capitalization rate, giving us our estimated market value rounded at $2,036,000. On page 4, we have some rent comparables. These are in similar area, similar structure. The first comparable has many more units, but it is still, it has a similar mix of apartments. And the rents range from $1,100 per month to $1,300 per month. On page 4, I transposed some of the numbers on the chart, so I would like to ask you to please disregard that. I put 21 units instead of 12. Sorry about that. We have our capitalization evidence on there on pages 7 and 8. And then we have the mailer starting at page 10, showing that for the 12 units, their monthly rent is $1,100 per month. And we've got some pictures on page 12 showing the neighborhood, just a map of where this is located, and a Google Street View of the buildings. Thank you.
Thank you, Ms. Martins. Any questions, Ms. Cates?
Yes, thank you. So on your income value summary on page 3, the city's cap rate would be below the 20th percentile. Is that correct?
Yes, it is.
And your rent comps on page 4, the comps are all larger than the subject on a gross floor area basis. So other things equal, larger units would tend to rent for higher amounts, correct?
Yes.
Okay. And then with your cap rate table on page 7, with the 4.75 to 5.45 range, do you know how many sales are being included to achieve that range, or how many high rise, low rise, etc.?
No, I do not.
And then for your cap rate sales on page 8, do you just have the final values, or do you also have the workups?
I don't have the workups of. Hold on one second. Just a moment. No, I don't have the workups available.
Okay. Thank you. That would conclude my questions, and then I also have some brief rebuttal to go through when we get to that point.
All right, I thank you. Mr. Whitbread, any questions to the assessor?
I just want to confirm your evidence shows 12 two-bedroom, yet, oh dear, let me see, I've lost it. Page 10. The owner has indicated 12 one-bedroom. Do you know what the correct configuration is for the suites?
No, I don't. The information that we've assessed this at is 12 two-bedroom.
Even though it clearly states on the financials 12 one-bedroom, eh?
I wasn't the person that put it on the roll, and I'm assuming that the person who did put it on the roll was given information that said 12 two-bedroom.
Okay.
We don't all of the properties based on everything that is sent in the mailers. If there is a discrepancy, then we are required to make a change.
Okay, you can maybe look at that. Thank you. No, I don't have any other questions.
Thank you. And Mr. Seelan?
You inspected this location?
No, I did not.
Is these numbers with respect to your income value summary, this is all model driven?
Yes, it is.
Thank you. That's all my questions, Madam Chair.
I thank you. My questions have been asked and answered. Ms. Cates, if you would like to give us your brief.
Thank you. So if you turn to page 2, we have a summary of some of the facts of the property, as well as our requested assessment of $1,821,000. In regard to the units, I'll just make a verbal correction. I believe that they filled in the 2022 INE on the wrong line, because as I was reviewing for today and I went back to prior INEs, they did indicate that it was all 2 bedrooms. So it doesn't change the financials that we're going to be going through, but I just figured I would start off with that. So if you go to page 6, we have the property site maps. So we have an aerial map view as well as a Google map view of the location. And then some exterior photos on page 7. On page 8, we have a property description. So the subject property is at the intersection of Bismarck and Pandora Avenue West in the Melrose area. There are 3 two-story buildings built in 2010 and 12 units, 12 parking stalls noted. On page 13, we have the overview of our income approach. So we are applying potential market gross rents of $158,400 or $1,100 per unit per month, based on the actual stabilized income achieved by the property. We note that the property had above market vacancy during the reference period, 5.4% in 2021, 6.5% in 2022. But properties with a low unit count can have challenges trying to maintain market vacancy. So for the purpose of the analysis, we are just applying a market vacancy of 2.6%. And for expenses, we are applying $63,217 or 41% of effective gross income. And that's based on a 3-year stabilization of the operating expenses, along with a 5-year stabilization of the repair and maintenance expense. On page 14, we have our cap rate for the property. We are disputing the city's cap rate of 4.5%, and we are using a cap rate of 5% based on our cap rate study. This property falls into the category of 2005 plus for a newer property. We note that it's wood frame. There are some amenities, including in-suite laundry. It is pet friendly, and the condition would be good. So we're not making any adjustments, as our base cap rates already contemplate good quality properties in good locations. So if you go to page 16, we have our income and expense breakdown. So we are applying an effective gross income of $154,282. I note that the parking is included in the rent, so there's no additional income stream. And then for the expenses, we have $63,217, which includes stabilized repair and maintenance of $645 per unit. That would be considered low, but given that it is a newer property, they do tend to have lower repair and maintenance. And we get a net operating income of $91,065 with a 5% cap rate, gives an indicated value of $1,821,000 rounded. And we have the repair and maintenance on page 17. And at this point, I'll just briefly go through our cap rate study, which is a separate document. If everyone has that available, then I'll proceed on that.
Madam Chair,
Yes.
wonder if I could ask that we get a high-level review. I believe most of us have seen this a number of times.
Yes.
Very high level. I'll be quick.
Thanks, Ms. Gaze.
Okay, so I'll just begin then by just saying, so on page 2, we just have an overview of cap rates and how they should be calculated and what should be considered. The main points here is that it's based on stabilizing prior financials into a single year's income expectancy, whether that being from 1 year of data or multi-years of data, as well, just noting that the cap rate is influenced by perceived risk, investor expectations for appreciation, and required returns from other vehicles. On page 4, we have some discussion regarding appraisal theory in terms of what should be considered in a cap rate, and the principle of anticipation is important to this approach. When calculating cap rates, it has to go beyond just a data entry and actually considering what the purchaser might expect to achieve from that income stream that they're purchasing. On page 6, we have an overview of the city's cap rates from their valuation manual. We note that their range is quite large, going from 3.5 to 7.95%. And in terms of what the brokers are saying for low rise, they're typically saying 5 to 6 or 5 to 5.75. CBRE is a bit more optimistic, but typically the compression would just be for the best of the best stock. So like concrete, construction, lots of amenities, stuff like that. On page 10, we have some of the factors that we might consider for adjustment. So I'm not making any adjustment for this property, but for one of the properties on the docket today, which does contain subsidized housing, we will be considering adjustments for like suite mix / suite size, durability and quality of income. And then we have our cap rate sales on page 12. So this just reflects a range of cap rates that we've looked at, and we've applied those fundamentals in calculating the cap rates. All of the calculations are to follow. And then just tying this up with the main presentation, I'll just go back to my main brief. So we have an appendix starting on page 19. I've included marketing photos that I found from their website. So this would probably be representative of one of the best units at the property since it's a marketing photo. And then I've also included the financials that we've looked at in our review. And that would conclude my presentation. Thank you.
Thank you. Ms. Martins, did you have any questions?
Yes. So I'm just looking for 738 St. Mary's on your cap rate study. What amount did you use for property taxes on that building?
We used around $3,000, which was what was reported. It was later brought to our attention that that was an underreporting of taxes. And when I calculated what the taxes would be for that year, considering the rebate, it would be about $13,000.
And how would that impact the cap rate that you would have on that one?
When I did a rough calculation of it, I believe it would take it to like a 4.7 or somewhere in that range.
Okay, but yet here we're using it at 5.26?
Yeah, like I said, it was recently brought to our attention. Evidence was submitted 2 weeks ago, so I didn't have time to update it, but yes, I'm aware.
Okay. And then 677 Maryland, would part of the very high cap rate be the amount of vacancy that was in the property?
Property had pretty high vacancy when it was purchased. I don't believe that a purchaser would expect to run it at like 30% vacancy. So we did take that vacancy down quite a bit, and we kind of utilized what CMHC might have been saying for vacancy in that area. Okay.
And we note that we have 2 different sales. You're using it a more recent sale on the property than we are in our cap rate analysis, right? Because our sale is from 2020 and your sale is from 2023. So when we're looking at the differences, we're using 2 different sales, correct? Okay. That's everything. Thank you very much.
I thank you. Mr. Seelan, any questions?
Yes, have you inspected this property?
I have not.
Thank you. That's all my questions, Madam Chair.
Thank you. Mr. Whitbread?
Yes, I'm looking at page 6 in your study, if you don't mind going back to that. Market reports.
Yes.
So is there a circumstance in which a building like this could acquire a cap rate of 4.5? Like, what would it take to get it to 4.5 in your mind? Because it is below the 25th percentile, obviously, and quite a bit below, actually.
Yes, in our mind, this property wouldn't be a 4.5. We believe that, like when I'm looking, the only ones that would be suggesting a 4.5 for low rise would be CBRE, and they look a bit more optimistic than the other two brokers. Yeah, I don't believe that this would be a 4.5. Like when we're seeing the compression too, it's typically thought to be for the best quality properties. And while this one is newer, I don't believe it's of a high quality.
No, but I think it's standard or good somewhere in your evidence or somebody's evidence. But would it have to be in ramshackle state for it to go to a 4.5, or would it have to be in a pristine state to go to 4.5? In your mind, I'm asking for your professional judgment here.
Well, when we're looking at some of these sales that do appear to transact at lower cap rates, typically it's going to be for properties that need work, that are in a lower condition, and then they're purchasing them with the intent to raise the income. So the actual true cap rate would be higher, but that would be my opinion of when you might see this type of property go at like 4.5. Is it?
That would denote higher risk, correct? Because you've got the trouble of renovating it if you need to. So there's higher risk for you.
Yeah, there would be higher risk in those because they would be assuming they can raise the rents, but that would present a greater risk to the income stream if they don't actually know that they can get those rents for the property.
And what's your understanding of the location of this property? Is it good? Is it bad? Is it a tough area?
I would say for this property, I didn't consider any type of location adjustment. It would kind of fall in that Transcona area. So I would say it's probably average.
Okay. No, that's good. Thank you very much. I have no further questions.
Thank you. Just one question, Ms. Cates, just regarding the vacancy. I believe you talked about the vacancy on this property on your page 13.
Do you want me to elaborate on the vacancy?
Well, I'm just wondering, to the best of your knowledge, is it continuing? You've got 2 years.
Yeah, I didn't look ahead to 2023 to see what that vacancy was like. But typically for these properties, when they have a low unit count, like let's say less than 20, it's not uncommon to see, 5-7% range, because if you have even a unit vacant for a few months, that's going to really it's going to have more of an impact on the proportionate vacancy of the property versus if you have 100 units, 2% vacancy would, just be a couple of units. I'm not sure if I hope this is making sense.
It is. Thank you. Yes. I
But
understand.
in terms of, and then just given that, we would expect this with less units. That's why I'm just applying a market vacancy, not applying a higher vacancy to the property. But yeah, I'm not sure if it is continuing for the foreseeable future.
All right. I thank you. That's all my questions. Now, I believe you said you have rebuttal.
Yes, I have rebuttal. I know everyone's also heard that a million times, so I'll be concise.
That's fine. I'm just, oh, there it is. Okay.
Do we have,
At this-
do we have that rebuttal, Madam Chair?
We do. It's at the bottom of our docket.
Is it the cap rate,
Yes, it says
apartment cap rate?
all
Okay.
rebuttal to the city cap rate.
Oh, I didn't see that one.
I also have rebuttal for the cap rate analysis for when it's appropriate to talk about if you're looking for things.
Oh, have you submitted it, Ms. Martins?
Yes, I submitted it a while ago.
Yeah, we usually distribute it when mentioned at the hearing, so I can distribute that now.
If you could, please.
Okay, thank you. So, Ms. Martins, I'm going to have you speak first to your rebuttal, and then we'll have Ms. Cates.
I don't think I have this rebuttal, Madam Chair. I'm just looking.
Ms. Graywood's just sending it out now. We'll have to just refresh and we'll.
Thank you.
Should be in your SharePoint folder now.
All right, great.
It'll also be near the bottom.
Thank you, Ms. Graywood. Does everybody have it?
Yep. 2 rebuttals. Is it the 6-9 A&T rebuttal that you just put in?
Correct, yes. Yep.
Yeah.
Okay. And I have Ms. Kate's rebuttal as well.
Mr. Seelan, you have both?
Yes, thank you.
All right, perfect. Ms. Martins, if you'd like to proceed.
Okay, and I believe as well with this that you've heard this many times, so if we do high level, if that's okay.
That's fine.
Okay, so on the first page, we have just an overview of our concerns with the sales. For sale 1 and 3, that's 345 Talbot and 738 St. Mary's Road. There's only 1 year of income and expense information, which is insufficient to calculate a stabilized net operating income. On sale 4, which is the 100 Maryland, there was no actual income and expenses involved in the calculation of the net operating income. And on sale 5, the potential growth income utilized by Altus is not based on historically reported information. So we feel that that is incorrectly stabilized. If you look through, we do have the information about each of the sales that we're speaking about on each of the pages. We do have some of the disbursement information going through, and it says like for 677 Altus calculation average rent levels are inconsistent with rents reported in the prior year. We're not sure where the information is coming from because it's not what was reported to us, and it's insufficient for properly stabilized in order to use for an appropriate cap rate study. Okay.
All right, thank you.
Thank you.
Ms. Cates, questions?
Yes. So in terms of sale 1 to 3, when it says unusable, to clarify, that would be the assessment department's opinion and not necessarily based on appraisal theory or IAAO standards, correct?
It's my understanding that we've been mandated to use 3-year stabilized. So I feel that that should be what we're using.
Okay. That would conclude my questions of the rebuttal. Thank you.
I thank you. Mr. Seelan, any questions?
No questions, Madam Chair. Thank you.
Thank you. And Mr. Whitbread?
I have none, thank you.
Thank you. I also have no questions. Ms. Cates, if you would like to present your rebuttal, please.
Okay, thank you. So if you turn to page 4, we have at the top some discussion on 727 Sargent and 241 Young. These cap rates are calculated by the city at 3.46, 4.21%. These are quite low, well below what we'd expect in the Winnipeg market for multifamily cap rates. And typically this would indicate that the purchaser is actually purchasing a different income opportunity and not the one in place. And additionally, they don't show their income approach or the data to arrive at those cap rates. 459 Sargent, they've used the historical income, but the market information that would have been available to a purchaser indicates that they would be able to get different levels of rent. And when I look on page 5 at the restabilization, that comes to a 5.79%, which is more in the range of what we'd expect for a property of this type and in this location. On page 7, 150 Hendon, the city calculates this cap rate at a 4.01%. They don't provide a stabilization, but it does appear they're using the historical income. We had the opportunity to interview the purchaser for this property, and they indicated that the vendor advised that they had applied for RTB increases, and the purchaser was purchasing with the property with the expectation of getting that higher income stream. When we recalculate the cap rate, we get a 5.42%. And then on page 22, 677 Maryland, the city is using an older sale when there is a more recent one available. That's right at our reference date. So that would be more accurate to use the more recent sale. And then 700 St. Mary's, 32 Arden, those properties have indications that they were purchased with the intent to renovate. So they're not reliable for a cap rate study. And that would conclude my rebuttal. Thank you.
Thank you. Questions, Ms. Martins?
Yes, when you are using different values to recalculate the cap rates, are you using post-reference information?
It's not necessary. No, it's not post-reference information.
Is it information from after the sale?
Yes, in some cases, it might contain some information from after the sale. Like, for example, with 150 Hendon, it transacted through land titles June 2nd, 2021. So I've added some 2022 information to further illustrate. So we are using some information after the sale to further illustrate, but for the most part, it's the information leading up to the sale and then market information that they might have had access to.
Okay, so it's not actual rents in place at time of sale?
Yeah, not necessarily for some of them, because if they're purchasing the property and they're intending to purchase a different income stream, then it's more accurate to use the higher rents.
Okay, thank you.
Thank you. Mr. Seelan, any questions?
Questions, Madam Chair?
Thank you. And Mr. Whitbread, any questions?
I would just like to understand that last statement you made, if you could clarify a little bit. So even though we're talking about future rent payments that post-date the reference date, you suggest that they could be used in calculations? Am I getting that right?
I don't know that I'd say we're using post-reference information. Like, we have utilized some 2022 information in there as well. But I would say the information that we're utilizing would be within the reference period. But what we are looking at is if the purchaser would expect that the income would change in a meaningful way from what the historical was, then it would be more accurate to use that different income that they would expect to be getting. Like, for example, with Albert, when they purchased that property, the broker flyer that they would have had access to said what rents they could be expected to get on a monthly basis. And while we do know that sometimes broker information can be a bit more optimistic, they wouldn't be able to report completely unreliable rents in there just due to professional obligations, stuff like that. So we would deem that information to be reliable to use. So in cases like that, we've used that information rather than sticking with the historical when it's going to change in a meaningful way.
So let me understand this then. I've applied for an adjustment, and let's use the 8.3 and 8.2, which they were granted. And the 8.2 is going to be used, it's income or revenue I will achieve after the reference point, reference date. Is that correct?
I would say it's, yes, the income you may expect to achieve after the sale closes may or may not be after the reference date. But I think we're sticking within the reference date when I'm looking at what we're using. Like I said, we have used some 2022 stuff, but I don't believe we've gone so far into the future to be beyond 2023, because most of these sales were kind of 2020, 21.
Okay. No, I appreciate that. No, thanks for the clarification. No further
Thank you.
questions.
Thank you. And I have no questions. So I think we have wrapped up 100 Bismarck Street. Does either party have a wish for a summation?
No, thank you.
As well. Thank you.
All right. And we will move on to item number 7, which is 675 Talbot Avenue.
Madam Chair, may I interrupt?
Yes.
I read somewhere in an email that there will be a request to confirm on this.
Yes, there will.
Are we able to ask the assessor to just read the highlights and present it for confirmation?
Yes, that's
Just in the interest of time.
yes. Ms. Cates, you will be asking for a confirmation, correct?
Correct.
Thank you. Ms. Martins, if you'd like to proceed.
Sure thing. This is roll number 14090503300. The address is 675 Talbot Avenue. For the roll year 2025 with a reference date of April 1st, 2023, the assessed value is $4,492,000. This is classed as 40, an institutional property with a liability status of S. It's taxable and school exempt. It is an apartment building and with 48 suites and 22 parking spots. Thank you.
Thank you. And Ms. Cates?
No questions. And at this time, I'll be requesting a confirmation of the assessment under section 54(1) of the Municipal Act. Thank you.
Thank you. Mr. Whitburn, any questions regarding this?
I have none, thank you.
And Mr. Seelan?
Questions, Madam Chair? Thank you.
And I also have no questions. So we will then move on to item number 8, which is 111 Gray Street. Just going to pull that up. And we are looking at assessed value for this property. And Ms. Martins, whenever you would like to begin.
Thank you. This is roll number 14091904000. The address is 111 Gray Street. For the roll year 2025, a reference date of April 1st, 2023, the assessed value is $3,289,000. This is class 20, residential 2. Liability status is taxable. This is an apartment building, 1 building, 2 stories. Actual built in 1968 with an effective built date of 1982. There are 24 suites with 22 outdoor parking spots. If we go to page 3, please. We'll see that we have 12 one-bedroom units and 12 two-bedroom units. That's our 24 units. It averages as $1,019.49 for average monthly rent per unit. Gives us a gross potential rent of $293,613. We've applied a vacancy rate of 2.6%, an expense rate of 45.95%, giving us a net operating income of $154,572. We've applied a capitalization rate of 4.7%, giving us the estimated market value rounded to $3,289,000. On page 4, we have some comparables. The comparables are similar. They are all 2 stories, all with 1 building each, and they are all built. They're all older than the subject property. They all have less than 30 units. We have an average monthly rent ranging from $828 a month to $1,045 a month. On page 5, we have our CMHC chart, which shows that the combined average potential rent income, sorry, I need my reading glasses for this one, is $328,368, and our modeled rent is $293,613. We have our cap rate information and the mailer information. The mailer shows that the rental income is $319,272. And at the back, we have some pictures. Just an overhead shot showing that this is on Gray Street near the intersection with Talbot. And there's a street view of the building. Thank you.
Thank you, Ms. Martins. Questions, Ms. Gates?
Yes, thank you. So just regarding the CMHC charts on page 5, if the subject property is under rent control and the CMHC data is using like a variety of properties, including brand new properties, it would then make sense for the subject to be potentially below the CMHC, correct?
We do have that there is a section of all the properties in Winnipeg are under the same guidelines by Manitoba Tenancies Branch. We do have a section that shows for the age of the buildings. So that would take into account the age of this building, because that's one of the factors that we look at.
Okay, but I guess in terms of, because some of these are just broad for the zone, so those would just include kind of all properties in that area, right?
Yeah, we're not using this to calculate the rent in our model. We're using this to show that the rent that is applied through our model is reasonable.
Okay, thank you. That would conclude my questions.
Thank you. And Mr. Seelan?
Yes, the effective age change from 1968 to 1982. We don't change that.
It would have been through some sort of major renovation or upgrade that was done at some point.
Okay. Have you inspected this location?
No, I did not inspect any of the properties.
Thank you. That's all my questions, Madam Chair.
Thank you. And Mr. Whitbread?
I have none, thank you.
Thank you. Just further to the effective age, Ms. Martins, do you have anything in your notes in regards to what took place in renovation-wise in this property?
Just taking a look quick. No, I don't have anything that pops out right now, but I didn't look at all of the permits or anything that may have been taken out of this property. I'm not sure when that change would have taken place. It could have taken place at any point in the past, I don't know, 30 years or more.
Okay, so I understand you didn't inspect it, and there's no interior photos, but just given the information that you've provided, how would you describe the condition of this building? Would you say it's average, good, below average?
We have it set to average. So that would be average according to other properties that are similar in this one. So it would be in the average to properties that are similar age group, similar qualities, similar conditions.
All right, I thank you. And Ms. Cates, if you would like to give us your brief.
Thank you. So if you turn to page 2, we have our requested assessment of $2,342,000. On page 6, we have the property site maps. And then on page 7, some exterior photos. Property description on page 8. So the subject property is on the east side of Gray Street, north of Talbot, in the Talbot Gray area. It is a 2.5-story building built in the late 60s with an effective age assigned. There were renovations done in the early 2010s based on our file notes. So presumably that would have prompted the effective age. The subject property has 24 units and there are 22 parking stalls noted. On page 13, we have an overview of our income approach. We are applying potential market gross rents of $270,020 or $938 per unit per month based on the actual stabilized income achieved by the property. We are applying a market vacancy rate of 2.6%. And for the expenses, we have stabilized them at $149,452 or 53.7% of effective gross income based on a 3-year stabilization of the operating expenses and a 5-year stabilization of the repair and maintenance. On page 14, we have our cap rate for the subject property. Our cap rate for a property of this age group would be 5.5%. The property is masonry. There's no amenities, which would have been typical of its construction at the time. Would say the condition would be good based on the photos that we reviewed. And there's just about 1-to-1 parking, a bit less. So on page 16, we have our income and expense breakdown. So with our potential gross rents and accounting for other forms of income, we have an effective gross income of $278,276. For the expenses, we are looking at stabilized repair and maintenance of $1,116 per unit for total expenses of $149,452 or 53.7%. I would say the repair and maintenance is on the low end, but that's to be expected when you do refresh the units, is that there will be what they call like an R&M holiday for a little bit because there will be less maintenance to perform. So we have a net operating income of $128,824 with the 5.5% cap rate, gives an indicated value rounded of $2,342,000. Items in red on the income and expense have been removed from any averages. And then we have the repair and maintenance on page 17, where we break it down line by line with where those funds are going to at the property. And then the appendix starts on page 19, and we have some marketing photos. So I would assume that this would be one of the better units at the property. And then we also include the valuation and the financials that we reviewed for the property. And that would conclude my presentation. Thank you.
I thank you. Questions, Ms. Martins?
Can you just run me through how, with their reported rent of $319,272, how your stabilized rent income ends up being $270,020?
Yeah, so on that form of the mailer where they put their potential gross, that's not including discounts. So discounts or rental incentives that they have to offer, that's income that they're not receiving for the property. So typically stabilizing the income would be the potential gross after discounts. And that would be the protocol that we follow through all of our valuations.
When you say have to offer, can you explain that to me?
Have to offer in terms of having to offer discounts to rent it up. So what tends to happen at properties, especially when they have some renovated units, is that they can get approved for higher increases for the units, but then based on the property manager or the owner understanding the property wanting to mitigate vacancy, they may have to offer certain discounts so that they don't have completely untamed vacancy at the property. So it's not something that always occurs, but sometimes it does. So they have fairly consistent discounts here.
So this would be the difference between hypothetically the amount that they report and the amount that the rents are registered at tenancy branch?
Yeah, so when they do renovations on the units, they have a timeline that they have to apply for the increases. And then if they don't apply for them, then I believe it could be too late later on. So what can happen is they'll apply for them, but then understanding the tenants, the market, they may offer then like a discounted rate on the unit.
Okay, thank you very much.
Thank you. Mr. Whitbread.
Well, I'm trying to follow up on that because that's a fairly significant line item. And I'm down into page 27 of your report. It's the financials. And so I'm looking at things like rental incentives, rental incentive move-in bonus, rental incentive retention bonus. Are those the kinds of things you're talking about that would make up that discount?
Yes, exactly. Sometimes they'll have different names for it on the financials, but it would, be anything that falling under the incentive or discount category.
Okay, so just as an example, what would a rental incentive be? I'm a tenant. What do I get?
So the rental incentive, like to me, when I look at this amount, this would probably be referring to consistent discounts that are showing up. So when you look at a rent roll, like you might see that this is the top line rent, but then we're giving $100 discount each month. So since this is the largest one, that's what I would assume is going on with rental incentive.
Yeah, that makes sense the way you explain it. We don't have a rental roll, unfortunately, so we can't check that, but that's fine. I understand what you're saying. So that's where that 40-some thousand dollars could come from in discounts. Those 3 line items typically.
Yes, and I apologize for not including a rent roll. I just we have to redact the rent rolls with the tenant names, and then sometimes the rent rolls are a million pages. So
Understand. Okay. I have no further questions. Thank you.
Thank you. And Mr. Seelan.
No questions, Madam Chair.
Thank you. And my question was asked and answered. Does either party have a wish for a summation on this property?
No, thank you.
I'm good as well. Thank you.
All right. I thank you. And we will then move on to our last item, which is item number 9, 110 Victoria Avenue. And again, we are looking at assessed value. And whenever you're ready, Ms. Martins.
This is roll number 09000401200110 Victoria Avenue West. For the roll year 2025, date of April 1st, 2023, the assessed value is $4,894,000. This has a classification of 40, which is an industrial property, and a liability status of S, which is taxable but school exempt. This is an apartment building. It consists of 1 building with 6 stories. It was built in 1994 with 39 suites and 13 outdoor parking spots. If we go to page 3, we'll see that there are 19 bachelor suites, 10 one-bedroom, 10 two-bedroom, giving us our 39, with an average monthly rent applied of $1,007.56. This gives us a gross potential rent of $471,538, a vacancy rate of 2.6, an expense ratio of 45.65%, which gives us a net operating income of $249,618. To that, we have applied a 5.1% capitalization rate, giving us the Estimated market value rounded to $4,894,000. We have comparables on page 4. These are similar, ranging in stories from 4 to 6, all single building. These ones, the comparables were built in the 80s. The total number of units goes up to 62 on the one comparable. And we have an average monthly rent ranging from $951 to $1,568 for the highest one. On page 5, we have the CMHC comparable chart. When we get all of the averages together, the potential rent of $439,836, where we have the modeled rent at $471,538. We have our cap rate information, and we have the mailers starting on page 10, showing the rental revenue coming in at $332,574, with other revenue coming up to $427,634. On the last page, we have some photos. So we have, on the second last page, we have 2 street view pictures showing the property. And on page 17, the last page, we have a map showing that this is on Victoria Avenue West, between Bond Street and Day Street, one street over from, 1 street north of Regent Avenue West. Thank you very much.
Thank you. Ms. Cates?
Yes, thank you. So for this property, given that it's seniors housing and the building has a high proportion of smaller units and limited parking, would you say that the market may find that less desirable?
I think that since we are supposed to be valuing it as market, I think judging that the...
Oh, excuse me, I'm just going to interrupt.
Sorry.
Whose dog is that?
That's my dog.
Oh.
We can take a break and I can see if I can control, but... Hold on. If you give me just one moment.
Okay, we'll just take 5 minutes here.
Okay, thank
Ms.
you.
Greenwood, could you just take us off? Thank you. Thank you.
I thought it was Miss Cates.
I'd like to call this hearing back to order. Okay, we will start with Ms. Cates.
Thank you. Okay, so given that the property is seniors housing, the building has a higher proportion of smaller units and limited parking. So would you agree that the market may find that less desirable?
No, I wouldn't necessarily agree at all. I think for its purpose, that's very desirable. If you're looking at trends, when COVID hit, people wanted bigger spaces because they were all working from home. And a lot of the time when people get older, they're looking for smaller spaces, and they're looking for spaces that are easier to control. And there's lots of people who do want smaller spaces, and they can be quite successful and profitable to have smaller spaces, because you can put more people in the smaller space, like more smaller units in a building. So I don't necessarily agree that just because there are smaller units, that it's automatically not a desirable building to have.
From an owner perspective, I guess if you had smaller units, you wouldn't be able to raise the rents as much. Would you agree with that?
No, because if you're looking at tenancies branch, it doesn't say that you can raise the rents 1% on bachelor apartments and 5% on 2-bedroom units. You may have, in fact, you could probably make more money, because then if you've got 2 or 3 bachelor units that are each getting, I don't know, 800, but I don't even know what the bachelor units are getting here, but if you're getting bachelor units that have their own income, as opposed to having a few 1 2-bedroom unit that is not making double the value that you're getting from a bachelor. So I think it depends on how you're looking at it. But no, I don't agree that just because there are bachelor units in a property that it's a bad investment, especially in this economy.
Okay. So this property is at least partially subsidized housing, correct?
Yes. I'm not exactly sure on the split, but yes, with being institutional and getting the school tax credit.
Okay, so then in regard to your CMHC comparison, how it's showing that the model is over 100% of CMHC, and taking into account that they're the at least partially subsidized units of this property, had you considered any adjustments to the income?
No, because as we've shown before, we are not using the CMHC chart as a tool to come up with the value. We're using it as something to compare with what we have in our model, to show that our model is not absolutely unreasonable. So even when our model is 80% below what the CMHC chart produces, we're not looking to increase those rents 20%. So it would be disingenuous of us to then, when our rents are slightly above what the CMHC proposes, to then automatically reduce them.
Typically for social housing properties or subsidized properties, the city would kind of crank the income quality down, and typically in their briefs, they always show how the model rents are quite a bit below CMHC. Do you agree with that, or?
No, I don't agree with that. I would say that on this property, it is already being valued as a below average property. So we have already applied an adjustment to show that this one is below the average of what we would be expecting for a property of that age, that size, in that neighborhood. So that's already been applied.
How has that already been applied when all the parameters are market parameters, like vacancy, expenses, cap rate?
Because they're market parameters based on a below average property as opposed to an average property. So we have different different levels of quality of a property. And so an average, if this building was not, some of the other buildings that we've spoken about today were average quality, and this one is below average quality. So taking into account that it's social housing and all of the things that we've discussed, we've already said that even for other properties that are similar size, similar suite mix, all of those factors, that this one is not an average quality one, that we've already taken into account that it's below average. So that will influence the amount of rent, that'll influence the cap rate, that'll influence the expense ratio that has been applied to it. So we've taken that into account already.
Okay. I think I'll leave it there. Thank you.
Thank you. Mr. Whitbread, questions?
Yes, just a little bit confused here, but we'll clear it up.
Okay.
I'm on page 13, and I'm looking at a whole bunch of life leases. Now, that's different than just renting an apartment, is it not?
Yes.
Can you explain the difference between a life lease and renting an apartment?
A life lease, there isn't just one set way of doing a life lease. So for more details about the life lease, it would probably be more appropriate to ask Farah. But a life lease in many places is more like a condo situation where there is an amount paid in order to keep the rent down. And then it's not that they need, my understanding of many of the life leases is that it's not that they have to renew their tenancy on an annual basis, that it's more consistent, that they don't have the questionable issue of having to renew their tenancy. But
So
Farah would probably have more better information about this building specifically.
I'm looking at the evidence you've submitted, though, so it's your evidence I'm going to look at.
Oh,
and we'll get to Ms. Cates when we get to her.
Yeah.
So I'm looking at this, and it looks like a rent reduction in a number of cases from your average of 1007. Some people are paying as low as 745. Is that correct?
Yes.
By the life lease, and some are paying 944, but nobody's paying the rent you've used. And then we have another group of employees who rent based on tenants' income. And it's again quite low, some of it. Now, where do I find the offsets in revenue for the subsidized? Is it in your statement, financial statements here?
Well,
I haven't been able to find that.
I didn't create the financial statements. I'm supplying the information that the
I know.
provided to us. So
I misspoke. Sorry.
that's,
They're not yours, the
okay.
owner's statements. Thank you.
Yeah, no, I'm not entirely sure, but it is common with subsidized housing that the rent is based on their income, and then then it's subsidized by the government, which is why this property is school tax exempt.
Yeah, I did find them on page 10.
Yeah.
Just so you know, there's subsidies for Manitoba Housing for RGI units, 73,357. So I'll tell you what I'm missing, though, and I'm going to come back down. I have to scroll back down, so bear with me.
Yeah.
On your page 12, there is a letter from Bridges Property Management, or to Bridges Property Management, to Brenda Bridges. And who is this from? Montrose Mortgage Corporation. So I'm trying to understand this. There was money paid by each of the life lease tenants into a fund, if I understand correctly.
It's similar to when you purchase a condo and money goes into the, like for the actual condo building. And it's in many cases for life lease. I'm not sure, like I don't know all the details on this specific one, but it's similar to that, that there's an amount paid in order to maintain lowered rents moving forward.
But unlike a condo, it's not for expenses.
Well,
incurred, unusual expenses incurred. That's a reserve in a condo. Yeah. Okay. So somewhere there's a bundle of money here, like $1 million, it looks like, close to.
Mm-hmm.
And let me just interrupt myself. Ms. Cates, are you going to be able to explain this in detail?
I'll do my best.
Life lease balances, you have a good idea of that?
I'll do my very best.
Okay, I'll continue here and then maybe you'll help us. I can't find interest payments on that. How many ever millions of dollars are in the life lease reserve fund? Can you help me with that?
Well, we don't really consider mortgages and interest owed or interest gained, because that's not the expenses that are applied to the building that are due to the building. That's more profits and losses that are attributable to the business. So we look at the value of a building as the building sits, because we're assessing all of the buildings in the city and we're trying to be equitable. So if it's not fair if we say, well, this building is worth more, like this building is worth more because you don't have a mortgage on it. If both buildings went on the market and you had a mortgage that you're paying interest on, whereas your neighbor doesn't have a mortgage, it doesn't mean anything for the value of the building. So we take that out of the equation for when we are doing an assessment. The interest and the additional fees and all of those things that are attributable to the business, that may be part of the investment aspect of the property, but that's not for assessment.
Because I get that for tenants who have a subsidized income, we get that revenue back on the 73,000 here. But I'm at a total loss as to the money, and let's use the top of page 13 again, the money these people paid into that life lease reserve, and they benefit from a lower rent. I'm not seeing an offset. When you use the income approach, we should be able to evaluate on the basis of an accurate rent, and we're not getting it here. But I'm going to leave it here.
I do have an answer for that one, though.
Oh, sorry?
I do have an answer for that, though.
Okay.
That's why we're supposed to be, for a lot of these properties that are subsidized or Manitoba housing properties, we are mandated to go to market and look at market values, because the actual values aren't, like, the actual rents paid don't reflect market. So that's why we use market values for all of this, so that we can value all of the properties equitably. So if this building is having life lease and is having rents based on income that are subsidized by Manitoba Housing, and an identical building next door is just having people who are in there renting as normal tenants, according to us, we look at it as those buildings should be the same value. So we should be applying market rents so that that's equal. That's why in things like life leases, condos, Manitoba Housing, we don't use the actuals, we use market.
And that's where your model comes up with the 1019 rent.
Yes.
Okay. I'm going to leave it there. Thank you. No further questions.
Thank you.
Thank you. And Mr. Seelan.
So everything is model driven when it comes to your income values, right?
Yes, it is. It is model as we would value below average property.
Okay. Thank you, Madam Chair. That's all my questions.
Thank you. So Ms. Martins, I'm just wondering, I'm just looking for some clarification. You had said your brief is model driven, correct?
Yeah.
And you're saying this property is below average.
Yes.
And in part because it's a social housing property, but you said that there has an adjustment has been applied. Was that through the model?
The adjustment being adjusting the quality to below average. And so this is what has the valuation that you see on page 3. It was produced through the model by us using the characteristic of it being a below average property. So in our model, we have average, above average, excellent. We also have below average and poor. So in order to reflect the characteristics and what this property is like, we've adjusted it so it doesn't come up with the average, it comes up with below average. But we need to recognize that below average, there are lots of buildings in the city that are below average. So when we are making our model, we do have information and data points from properties that are below average. So we can still make a model. This is just one of the characteristics that shifts a little bit. And then it will then adjust some of the other factors that we want it to, so that it's applying fairly. Does that make sense?
It does, somewhat. So I guess I'm wondering then, because the model came up with a 5.10 cap rate.
Yes.
So I'm just thinking, if this was below average, that cap rate is still quite low. If this is a below average property.
That depends on who's that depends on whose information you're using, right? So when we are looking at our cap rates and what we are applying, we're looking at valuing the properties equitably. Our mandate is to look at all the properties in the city and apply equitable assessments for the purposes of taxation. And that's what we're looking at. We're not looking to serve investors. We're not advertising that, hire us and we will lower your taxes. We're just applying equitable assessments across the board so that we can disperse the taxes in a fair manner. So as part of that, the capitalization rate that we have comes up from our calculations with being similar properties, similar areas, all of these other things. This is what the model has said, that a below average building of this type, age, neighborhood, the capitalization rate that we would expect.
So does the model look at other properties that are similar to this in regards to that they're social housing, that they're subsidized, that they're life leases?
We don't have a different property type class for social housing because our mandate is to treat it equitably. So we value it to market values. So it's compared to other properties. We don't differentiate between this. When I look it up in my system, I have to look at the ownership to see if it's or the classification to see if it is subsidized housing or what it is, because we don't differentiate between them. Even in the big decision that is frequently quoted about how we have been mandated to apply a 1% increase in the cap rate for social housing, that was actually interestingly quoted because the decision was based not on a 1% increase in the cap rate. It was based on neither party having a solid enough argument to convince the municipal board which direction that they should go with the cap rate. So they split the difference. So when we're looking at all of this, we're mandated to be equitable. We're mandated to treat them as regular houses or regular apartments or regular properties. We value them according to market.
All right, thank you. Ms. Cates, I believe you are up if you would like to give us your brief.
Thank you. So if you turn to page 2, we have our requested assessment of $3,142,000. On page 6, we have our property site maps, and then some exterior photos on page 7. Property description on page 8. The subject property is on the south side of Victoria Avenue West of its intersection with Day Street. It is a 6-story building built in the 90s. There are 39 units with a higher proportion of smaller units, which makes sense given that it's seniors housing. And there is limited parking at the property, not 1-to-1 ratio. On page 13, we have the overview of our income approach. So the subject property is, at least in part, operated as subsidized housing. It is for seniors. So many of the units here are on a rent geared to income basis, meaning that the rents achieved are not at market. They're based on a proportion of income. So in order to use market income, we are looking to CMHC. So in this case, we are disputing the assessor's rents. When we're looking at properties that are social housing properties, they would have lower end finishes. They're more utility grade than pure market apartments. So they shouldn't be above CMHC rents. Typically, we would apply something that would be potentially 80% below CMHC. But in the case of this, since it's not a fully subsidized property, just to be reasonable, we're just going to apply the straight CMHC rents, no deductions. So we felt it most accurate to look to the area, because location is going to be a huge determinant into how much rent units can get. So in looking to the 2021 and 2022 CMHC rents for that zone, we get a average rent of $884 per unit per month. For the vacancy, we have consulted CMHC and we're using 2.6%. And then in terms of the expenses, we did review the actual expenses that were reported, but we note that they were quite high. So in order to be reasonable for the analysis, we are capping the expenses at 55%. That would be a dollar amount of $220,845. Typically, if I was working with an older property, we might cap the expenses higher at 60 or 65%. But given that this is newer from the 90s, we are going to cap them a little lower at 55%. So in terms of the life lease aspect, life leases typically would work that the tenants pay a refundable entrance fee and the rent payments are based on the operating costs of the property, which would include repair and maintenance and reserve expenditures. So if you turn to page 15, we have an overview of how we approach cap rates for social housing, subsidized housing properties. So we look to the valuation and market studies for affordable housing text written by Richard Poulton. And what he suggests is that it should start with a market cap rate and then adjusting upwards for risk factors, because these properties aren't really transacting in the market. And when they do, they tend to have a lot of atypical conditions associated with their sale. So they're not reliable for cap rate studies. So he breaks down the characteristics into a variety of categories, but they can be summed up in terms of 4 broad features, being low quality construction, age, declining neighborhood, and low income tenancy. And when we look to what the board orders are suggesting, I'd have to disagree with Ms. Martin's characterization of what the orders were suggesting. When we look to those orders, they're suggesting that even with lower end rents, higher vacancy, higher expenses, a cap premium may still be warranted. So it's not that neither side won that case. The main thing is that a premium was warranted. So on page 17, we have a discussion on low income tenancy. The main point being that low income tenancy is linked to deferred maintenance. When properties don't have enough operating revenues to cover their operating expenses, they rely on subsidies to fill those gaps. And what then happens is they don't have enough funds to then cover all of their preventative maintenance and repairs that may be required. This leads to issues building up and the severity of issues building up over time. So on page 19, we have our cap rate for the subject property. We are disputing the current cap rate of 5.1%. We are applying a cap rate of 5.75%. We've done a 0.5% adjustment to the cap rate based on social housing, low income tenancy, and then also considering seniors housing, that it has low parking and the suites are small. When you're looking at it from a market perspective, smaller suites have a more limited capacity for increasing the rents. So that would be considered less desirable from a market ownership perspective. If you go to page 21, we have our income and expense breakdown. So we are using an effective gross income of $401,536 with 55% expenses. We have a net operating income of $180,691, and with a 5.75% cap rate gives a rounded value of $3,142,000. We have the repair and maintenance on page 22. And then in the appendix that starts on page 24, we have the valuation as well as the financials that we reviewed, and then some further information regarding social housing. And that would conclude my presentation. Thank you.
Thank you. Ms. Martins, any questions?
No, thank you.
And Mr. Seelan?
Have you inspected this property?
I have not.
Thank you. That's all. Any questions?
Thank you. And Mr. Whitbread?
Yes. The life lease arrangement. those 20 people that have life leases in this building, and I took that, I believe, from the evidence provided by the assessor, there were 20 people on the life lease section. Do you know what the buy-in to the life lease is? What lump sum do they have to make?
I don't have the figures for what the buy-in would be.
I see on page 10 of the assessor, or page 12 of the assessor's evidence. I'll just give you a second to get there.
Yeah, I'm there.
0.6 in the letter, 12 payments of $11,080. Would you have any idea what those payments would be respective of?
Am I on page 12 of the assessors?
Yes. Point number 6. You have it there?
Yeah, I'm looking at it. Yeah, no, I can't speak to exactly what those payments would be.
No speculative thinking here. Like, all I can speculate that is those are some of the lump sum payments that have to be paid. But it seems like it would be higher than that, and maybe it's over time. But anyway, we can't speculate. So do you know on a life lease, if I'm a tenant, do I get my money back when I die? Does someone get my money back when I die?
Like what I have noted for life leases would be that it would be a refundable entrance fee, but in terms of your rent payments, those wouldn't come back because the rent payments would be supporting the operating of the property.
That's right, but somehow there has to be balancing out. If you look at the lower rent I'm getting, I'm having to pay each month against the lump sum buy-in that I made, there must be an offset somewhere. And does a balancing happen? And I still would have the ability, or my estate would have the ability to get some of that money back. Do you know?
Yeah, I would assume that, yeah, that some of that would come back. Presumably, the fees that people are paying would be put in, earn interest likely over time, and then, then they have funds to do things with the property and then also refund the entrance fee and someone moves out, someone new comes in.
And that's the part I'm really struggling with, because I'm not finding that the interest revenue anywhere in the statements. And I understood Ms. Martins to say that they're not responsible for capturing those kinds of earnings on the financial statements. I'm still having trouble understanding that. I'm going to leave it there. I'm going to have to find somebody who understands this topic thoroughly and pick their brain. Thank you. I have no further questions.
Thank you. And I have no questions. Does either party have a wish for a summation?
No, thank you.
Good as well, thank you.
All right, I thank you. So that concludes our docket this evening. We have heard all the items on the docket and our hearing is now adjourned. And I would just like to thank Ms. Martins and Ms. Cates for their briefs this evening.
Thank you.
Thank you both.
Yeah.
Thank you.